Hello traders, hope you are all doing good. So in today's video we will talk in brief about delta hedging. So you must be knowing, as an option seller or an option trader, you must be knowing what is delta. Delta is one of the components in option pricing model. So you have delta, theta, gamma, vega. So there are everything and many things. And option Greek itself is a very brief subject, and if I want to explain all these things I have to put a separate video. So we will not look at other things. We will just look at delta and we will see how delta works and how we can benefit or how we can make profit using delta hedging. Now delta is a component in option pricing model, and delta can be interpreted in two ways. Either the first thing is that you can see it as a probability of the option getting exercised in the money. If you for example you are buying a call option and you know all the delta of a at the money call option. Let's say for example 18,000, let's say Nifty 50 is at 18,000, spot is trading at 18,000, and if you buy at the money 18,000 call option which is expiring next week, it will be having a delta of 0.5, which means there is 50% probability either the market can go downside or the market can go on the upside. So at the money call option, if you buy at the money call option 18,000 strike and Nifty spot is at 18,000, so it will be having a delta of 0.5, which means there is 50% probability that the option can expire in the money or out of the money. Now if you know, if it is expiring in the money, as an option seller, if you are trading at indices, it is going to be cash settled, or if you are trading stock option, it is going to be delivery. You have to take physical delivery. So I am not going into that. Now out of the money call options have lesser delta, which means, let's say for example at the money is having 0.5 delta. So out of the money call options will be having 2 delta or 3 delta. It depends how far you go. At the same time, if you see deep in the money, it will be having a delta of 0.7 or 0.1, which means there is high probability of the option getting exercised in the money. So that is why option buyers don't opt to go and buy out of the money call options or out of the money options, because they know if they buy out of the money options, they are not going to win. Either they will buy at the money call option or they will go and buy deep in the money call option. Now that is the first interpretation. Second one is the moneyness. Let us say you are buying a call option, okay? Nifty spot is at 18,000 and you are buying a at the money call option. Now it is going to have a 0.5 delta, which means you consider you don't have to apply any logic and you forget all of other things like vega, gamma, theta, everything you forget. You just focus on delta. Now as you anticipated, if the market, you have bought a call option, and as you anticipated, if the market moves on the upside, so every 1 point move you are going to make that much delta, 0.5 delta. Now from 18,000 market goes to 18,300. So as and when delta increases, your probability, the delta, as the delta increases, your premium is going to also increase. The more it increases, the premium is going to increase. Let's say you bought for 100 rupees with a 0.5 delta. When it goes to 70 rupees, it is going to earn more money. So it is called moneyness of a option or moneyness of the premium. So first is the probability, second thing is the moneyness. Now delta can be found. Now if you ask me where to find the delta of an option, it is very simple. You can either go to your broker terminal, or if you want, there are many option trading platforms where you can go and find delta. Now I will show you one example. So this is the sensible I am using, and I am going to strategy builder. Now Nifty spot is at 18,100. Now if I buy a call option, you have to remember, you can find the deltas or Greeks in this module. So I go to strategy builder, and in Greeks there are many things like delta, theta, gamma, vega. So if you see here, call options always have a positive delta and put option always have a negative delta. So when you buy a call option and if the prices increases, the delta, the option premium also increases because delta is positive. If I sell the same call option, let us say I am, instead of buying the call option, if I sell the call option, I will be having a negative delta. See here, when I was buying this 18,150 call option, it had a positive delta of 22. If I sell the same option, it is going to be delta of negative 22. So when I buy a call option and if the market moves on the upside, I am going to make money because the delta is positive. So when the delta is positive and the market moves on the upside, you are going to make money, and if the delta is positive and the market goes down, you are going to lose money. At the same time, the opposite happens to when you sell a delta, right? When you buy a call option, delta is positive, and when you sell a call option, the delta is negative. Now, how does this strategy or how does this delta helps us? Now, you may ask one more question: why is the delta here 22? Let us say now delta, if you see here, delta is showing around 22. Now, how do you know what is the delta? Just simple thing, go to calculator. Now it's a very simple calculation. 22 divided by 50, that is 1 lot, is equal to 44. Now 44 into 50, how much? It is 22. So the delta here is around 4.44 delta. We are having, if you know, Nifty is around 1 lot is around 50 units and 1 unit is having 0.44 delta. So you have to remember this in mind. Now as I told you, when you buy a call option, it is going to be positive delta, and when you sell a call option, it is going to be negative delta. At the same time, when you buy a put option, it is going to be negative delta, and when you sell a put option, it is going to be positive delta. Now I'll show you that example. Instead of, now what I did is I bought a 18,150 call option. Instead of call option, if I buy a put option, if you see here, the delta is around minus 28, and if I sell the same put option, the delta is going to be 28. So you have to understand. So you sell a put option and delta is 28, and if the market moves on the upside, obviously you are going to make money. So this is the simple concept of delta. I hope you understand this delta concept or how these things work. You don't have to look at that's what I told in the earlier part of this video. This option Greek is a very complex subject, and I have to put a separate video to explain the whole concept. Now you just remember about delta, and we will just focus on delta, and you assume everything else is not changing, only the delta is changing. Now let us see some examples. Now let us say if you build a strategy, let's say you are doing a short straddle. Okay, now if you see here, the delta is around 6 because the call option will be having a negative delta of 22, and put option will be having a positive delta of 28. So positive plus negative plus positive is equal to positive, right? So if the market, let's say if the market is range bound in between, if you see in this straddle, the break even point on the upper side is 18,697 and the lower break even point is around 17,930. Okay, if the market moves in between this range, straddles are going to make money. Now what is going to happen if the market keeps on moving on one direction? Okay, it is going keep on moving from 18,150, it's keep on moving to 18,500 or 18,600. So whatever it is, keep on moving on one side, it is unidirectional. So what you do, how we can use delta hedging to manage times like this, or how to convert your loss making position into profit making position using delta hedging. Now let us say, for example, on Monday 15th November you took a strategy and you took a straddle and you are sure that the market is going to shoot up. Now as you anticipated, market is moving violently to, let us say it is moving to 18,300. Now you are hardly 50 or 60 or 70 points away from your break-even point. now if you see here, your delta has earlier when you started this strategy, the delta was positive 6 delta. Now it is showing minus 30 delta. Now your every 1 point move on the upside, you are going to make lose money. You are going to lose 30 rupees for 1 unit. How you are going to manage? No problem. This negative delta, since the market is moving on the upside, this negative delta you have to convert it into positive delta. To do that, what you have to do is, since you have sold 18,150 call option and 18,150 put option, and you know, since the market is moving on the upside, this 18,150 call option, which would be 18,150 put option, which was in positive delta, would have come to, maybe the delta would have increased from 0.5 delta, it would have come to maybe 0.3 delta, but the call option which you have sold, which is a negative delta, would have increased because it is going deep in the money. Now what I do, I go and buy one delta, right? 18,200 call option, which is going to be around 74 or 75 rupees. Now once I do this, if you see here, my delta has come from negative 33 delta to positive 7 delta. So which means every 1 point move in Nifty, I am going to make 7 rupees since the delta is positive. So very simple concept. When the market moves on the upside, you have to be in positive delta, and when the market moves on the downside, you have to be in negative delta, right? So if you see here, this I will just clear the put option because we are not concerned about the put option, and we will just focus on the call option, right? Now if you see here, when we did this strategy, and I am telling you again, you don't have to put any logic. I am just telling you how to understand this delta. And today morning when we did this strategy, the delta was around negative 23 or something, right? Yeah, negative 23. Call option, when you sell a call option, it is always going to be in negative delta. Now once I buy this call option, the delta is going to come below 3 from 22. The delta is now at around 40. When the market was around 18,150, we did a strategy with the negative delta, call negative delta and put positive delta, and market has moved to 18,300. And since the market has moved to 18,300, your sold call, which is having a negative delta, is going to further increase. The delta is going to further increase. So it has increased from negative 23 delta to negative 40 delta. Now, you know, if I buy a call option, it is going to be positive delta. Once I do that positive delta, it is giving me 37 points positive delta. So 40 minus 37, now I am with a negative delta of 23. Plus always I have sold a put option, so my it is going to be a positive delta. So minus 3 delta plus whatever 10 delta, it is going to be 7 delta. So I am net, my whole position is now positive 7 delta. So you have to understand this concept. Now this is just an example. I am just showing you, like it is just a thought-provoking process. You will have to think how you will have to work out. Instead of buying a call option where I bought I sold a 18,150 call option and I bought a 18,200 call option. So negative plus positive is equal to negative, right? Now what I did here, instead of buying a call option, you can go and sell put options as well. See, put option, when you sell a put option, it is going to be negative delta only. Let's say for example, instead of buying this 18,200, what I can do is I can go and sell maybe 18,000 another lot. So if I do that, still my delta is going to decrease. Let's say for 18,800, instead of selling one option, if I sell two options, it is going to be 23 delta. Or we will just put it this way, instead of going to 18,000, if I sell 5 lots of 18,150, my delta is going to be increasing 11,000. So earlier example, I bought 18,200. If you see here, yeah, 18,200. I think I didn't switch the screen. See, what I did here is before I bought 18,200 call option, and from negative delta to positive delta I have converted. Instead of doing that, you can also sell call or put option. Now instead of buying 18,200 call option, I can go and sell maybe 5 lots of 18,150 put option. So put option, when you sell, it is going to be positive delta. So it is going to be 11 delta, positive 11 delta. So as I told you, this is just a thought-provoking process, and you will have to figure it out how you are going to work out with these strategies. And many times what this will happen, honestly telling you, this is going to be an expensive affair, and it is going to cost you, and you will require lots of money if thing goes wrong. Let us say if the market gaps up or gaps down by 200 or 300 points, you are going to be in trouble, and you will need lots of money to make adjustment. Or let us say market is gapping down, you will be having a very negative delta, you will be having a very positive delta. Since you are a non-directional trader, you will be having a positive delta. You will have to convert that positive delta to negative delta. Since the market is going on the downside, you will have to always be in negative delta. Simple thing, I will tell you again, when the market goes down, your position should be negative, and if the market goes up, it is going to be, you will have to be positive. So again, I am telling you, this is a very brief and big subject. I cannot explain in one video. In case you are not able to understand, let me know. I will just post, let me know in the comment section below. I will post one more video about this delta hedging strategies. I hope you find this video very useful. Thank you for watching. Take care. Bye.